You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means it is Thursday. It is 1:30 p.m. Central, 2:30 p.m. Eastern. Time to dive deep into the world of futures options. Yes, it is time for TWIFO. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from this fine network upon which so many of you are listening to this fine program right now. If you have just discovered TWIFO in the recent past, I should say, and a lot of you have, clearly, looking by how many people continue to flow into these shows, then make sure if you haven't done so already, head on over to the full network, subscribe to the full kit and caboodle. We will keep you engaged with the option space literally every day. There's content hitting that network, so we get it. We know you like TWIFO. We appreciate it. Make sure you get the whole kit and caboodle, because if you're just getting TWIFO, you're missing out on a whole heck of a lot. And, of course, wherever you listen to this fine program, if you like what you hear, leave a review to continue that influx of new listeners. We just celebrated episode 200 here last week. We want to have episode 400. Keep those new folks discovering the program to help that come to pass. And, of course, if you have a question, a comment, an insight, we'd love to hear from you guys. And joining me on the program today, first off, holding down that FTSE Russell hot seat, my old friend / compatriot / partner in all things futures, options, volatility, and skew crime. He is Mr. Sean Smith, the Managing Director of Derivatives Licensing over there in FTSE Russell land. Mr. Smith, welcome back to TWIFO, sir. It has been too long.
Mark, it's great to be back on the show. Thanks for having me. Looking forward to another exciting episode. And we're coming off of your 200th anniversary, of which I'm still celebrating it.
I was going to say, have you recovered from the high, from the palooza that was TWIFO 200, sir?
It's kind of like Mardi Gras for a week. We're just going to keep celebrating here.
That's what we do here in the studio, just celebrating day in, day out. You guys can celebrate along with us. CMEgroup.com/TWIFO is the place to go to generate all these reports that we're going to talk about during the show. You guys can do that for yourselves. CMEgroup.com/TWIFO, the place to go to get started on that journey. And joining us today in the CME Group hot seat, he's a newcomer to the program and indeed to the network. He is John Brady, the Managing Director of Global Institutional Sales. Say that 5 times fast. Over there at RJ O'Brien. John, welcome to the TWIFO program, sir.
Thanks very much, Mark. I'm honored to be here. Thanks for including me.
I do believe, John, I'll have to go back and check into our extensive, nearly 14-year history, but I do believe, John, you may indeed be the first guest from RJO on our network in that extensive time. I'm not sure how that's even possible, but there you go, John. You have broken the drought. Congratulations.
Thank you very much.
John, as we are wont to do with all of our first-timers here on the network, why don't you go ahead and give our audience a little bit of an overview of your background in the derivative space as well as what it is you do day-to-day over there at RJO?
Sure, Mark. So I've been lucky to be in the listed derivatives business for the better part of 27 years, all on the institutional sales side. I started out on the trading floor, CME, Eurodollar options, and futures specifically in the early 1990s. Had my formative years with J.P. Morgan before their merger with Chase. Spent some time with Bank of Montreal, with Aubrey Lanson, which was a subsidiary of the Industrial Bank of Japan. Spent 10 years, close to 10 years with Man Financial, MF Global, and then I spent the last 8 years here at RJ O'Brien. So I've had the privilege of working with large money center banks. I've worked with foreign banks, and now having been here at RJ O'Brien for 8 years, as you know, we're the single largest independent FCM in North America, in the Western Hemisphere. We've been in business for a little bit more than 105 years. And I matriculated from the trading floors to the upstairs world as technology was taking hold in 2002, 2003. And so I currently work on a desk with 16 other talented individuals here at RJ O'Brien, and we're lucky to talk to rather large wholesale institutional users of listed derivative product. They use CME product to either hedge out liabilities or asset risk, or to perhaps try and generate alpha for their portfolios. Our clients include large state pension funds, insurance companies, relative value hedge funds, macro hedge funds, bank portfolios, as well as large East Coast and West Coast asset managers, as well as large foreign institutional banking centers. So we have sort of a diverse book of clients here at the firm, and we're lucky enough to see a lot of sophisticated users of the products come through our desks. And again, we're lucky to kind of see that flow and sort of take advantage of that for just, in terms of keeping our clientele up to date as much as possible in terms of what's exactly kind of going on in the markets and more specifically where the opportunities are.
Another former Eurodollars guy here on the show. The show's lousy with former Eurodollars guys. We started it with Nick. He's a former Eurodollars guy. Sean, of course, former Eurodollars guy, which actually I just heard Sean has a family emergency, has to hop off. So, Sean, hopefully things are well over there with you. We'll check back in with you again next week. I think John and I we'll do an able job holding down both hot seats for you here this week. And, of course, now John coming in on the former Eurodollar side. This is usually where I ask Sean, Mr. John, but I'll give you pride of place as our CME hot seat guest this week. We start the show every week looking at what's moving and shaking to the upside and the downside over there at CME Group Land, a.k.a. the light side and the dark side. So, John, where should we start? To the upside or to the downside this week, sir?
Well, look, I mean, Mark, I think, there are a couple of stronger cross currents coming into our markets. Obviously, the big trade over the last 3 or 4 months has been obviously this COVID-19 trade, and the repricing of risk assets to lower levels, and the move to dramatically lower yields along the Treasury and Eurodollar futures curves, and of course the historic presence of the Federal Reserve and the Treasury Department, both in terms of supporting risk assets within our market. So, against a kind of a relatively, kind of unknown pandemic, and both the financial consequences and economic consequences that are coming out of this this unfortunate experience. So that having been said, whereas there's been a bit of a normalization trade taking place as equities have kind of moved higher a little bit. Treasury yields, for the most part, remain pretty closely anchored to that zero bound, at least on the front of the curve. But there are other there are other cross currents or riptides that are kind of coming into our market. And what really kind of within the last week, what's creeped up here are two significant events. First, increasing tension specifically between the United States and China as it regards Hong Kong, amongst a number of other things. Technology transfers, trade, geopolitical concerns, whatever else. But certainly China's increased presence within Hong Kong is certainly has our attention. And then likewise too, recently we have this spat coming out of the White House between the White House and some of these social media platforms, specifically as it relates to their waiver of liability that, as you know, goes back to 1995, and exactly what's going to transpire between companies like Twitter and others who now sort of want to police more carefully what transpires on their social media platforms without being legally liable, and whether the White House or Congress is going to let that be. So that's had some effects, and it kind of lends itself to some volatility, or at least rotation out of maybe some high-flying NASDAQ stocks this week, maybe the smaller cap stocks. So those have really sort of been the issues that we've been focused on this week.
That's a lot to unpack. We're going to get to a lot of that in a second. I'm going to break all that down. I'm going to say, in the spirit of Sean, I'm going to say we want to start to the light side up here, a.k.a. the green movers, which are outnumbering the red over here on our movers and shakers report for the week, listeners, but only ever so slightly. So it's not quite we've usually seen major trends in one direction or the other every week on the show. It's usually mostly green or mostly red. This week, it's close to 50-50 here on the movers and shakers report. Number 5 to the upside this week, Rough Rice up 4.71%. Number 4, the Dow, pretty much all equities the rest of the way here, listeners. Number 4, the Dow up about 5.25%. Number 3, the S&P Midcap 400, the only real domestic index that is even within spitting distance of the Russell 2000 these days. It's at about 6.43%. That means the Russell 2000 at number 2, 6.85% to the upside. What has the temerity to outpace the Russell 2000 to the upside? Well, you got to go outside of these shores all the way to the Nikkei, listeners. That gets you up 7.5% this week. So it has been pretty much all equities all the time here this week. To the dark side, we got number 5, RBOB, a little bit of energy on the dark side this week, off about 3.14%. Number 4, heating oil, off about 4%. Number 3, WTI, off about a little bit north of 4%, about 4.06%. Then we got number 2, palladium, finally taking a break. It was our number 1 mover and shaker to the upside on the entire history of this program, as we broke it down last week on the historic TWIFO 200, listeners. If you missed that one, go check it out. That was a fun one. We broke down what was been lighting it up for the entirety of this 4+ years of this show here, and it's been kind of fun. Palladium, spoiler alert, was number 1. Giving some of that back this week, off 5.65%. And number 1 to the dark side, iron ore, off 8.87%. Before we get breaking down some individual complexes, I kind of want to touch on what you were just talking about there, John, which is been top of mind for just about every guest on every show on our network. I don't care what you're coming to talk about initially. Everyone's got this on the brain these days, which is what you just alluded to. The interesting dance we're seeing going on out there in the marketplace right now, where there's all the issues you alluded to. There's the growing tensions between Hong Kong and China, and therefore the U.S. There's, of course, the lingering issue that is the pandemic. What will happen with the social distancing? Will it make it worse? What's going on with the vaccine? And yet, almost in spite of all that, we've seen this protracted rally continuing all week, particularly in the equities, as I just pointed out here. I'm curious for you, if you have any viewpoints on this, have at it, but also, what are you hearing from your clients, these institutional traders? Could be on the fixed income side, could be on the broad traditional equity side. What are you hearing anecdotally from these folks? Are they buying into this rally? They think this has some teeth? Are they a little bit skittish? What are you hearing out there these days, John?
Well, Mark, I think there's a couple of things going on. First of all, as you know, in our markets, there's that old saying, right? You don't want to fight the Fed. And I think it's pretty clear here that the Fed currently has the back of investors, institutional, retail, somewhere in between. The Fed certainly has the back of investors. And certainly what happens this week is that both the European Union and Japan joined in that as well. So we've had incredible monetary policy support by the Federal Reserve and by the Treasury, but there's also been fiscal policy support, as you know. Let's say, for example, like weekly jobless claims and the amount of money that's being doled out to people who unfortunately have lost their jobs because of this COVID-19 experience. And so physical as well as monetary authorities are working in great concert here in the United States, but they've also stepped up this week overseas. Japan, for example, announced a $1.1 trillion supplemental budget to their $1.1 trillion stimulus program announced 2 weeks ago. So that has certainly helped the Nikkei perform the way it has on the light side during the course of the week at up over 7.5%. Likewise, too, over in Europe, European authorities, now they will need a vote of all 27 EU nations, but it appears as if the European Union is likewise going to join forces with the ECB, and the European Union is also going to issue out about $1.1 trillion in bonds, and a $1.1 trillion stimulus package will be kind of rolling through the European economy. So on a global scale, the major economies, Europe, the United States, and Japan, seem to be sort of all working in concert between the monetary wings and their fiscal policy wings to sort of support risk assets. So with the Fed having one's back, right, the path of least resistance has been a little bit to the upside of most of these major market indices. Likewise too, from a sentiment standpoint, if you kind of go back and look at those March 23 lows, we seem to have a lot of bad news built into us. As you recall, for example, early on in this pandemic, there was a lot of talk about the models coming out of places like King's College in London, where the epidemiology staff there had suggested there would be perhaps as many as 2 million deaths here in the United States due to COVID-19. Well, look, every death is unfortunate, and every death has been sad and tragic. But from a market perspective, as we've crossed the 100,000 threshold recently, there's been sort of a realization that, hey, we had too much bad news maybe priced into us. And so now, as equity markets have recovered and risk has recovered, again with the background of fiscal authorities and monetary authorities working in concert, you have this trade taking place that I think is best described as FOMO. There's a fear of missing out. And so what you're seeing slowly defensive type trade, defensive structures being unwound as the market just melts higher. And again, I think there's a realization here as COVID-19 curves flatten, as the death rate slows, as cities such as Chicago perhaps start to slowly open up, that, hey, you know what? All things considered, especially as a zero interest rate parameter, risk assets here may be worth a little bit more of a shot. So the allocations out of risk-less assets into risky assets seems to be gathering some momentum.
Wise words. Don't fight the Fed. They clearly have the stimulus in mind. They're very accommodative right now. Speaking of the Fed, let's get into the rate slant. I know that's your neck of the woods there, John, as well. You touched on earlier how you transitioned from the trading floor to the upstairs environment. It's a very top-of-mind sentiment right now because everyone's wondering, when are we going to transition back, particularly in your old stomping grounds out there in the Eurodollar? When people hold up a pit and say this is the floor trading exemplar, this is the one that would have the hardest time transitioning to an all-electronic environment, Eurodollars is first and foremost on that list pretty much every time. Yet it, along with everything else, has transitioned to an all-electronic environment out there. There are some people questioning when we're going to start seeing that pit come back. Of course, we saw NYSE come back earlier this week on the stock side. SIBO has announced they plan to come back with the SPX in June 8th. So in a week and change, we're going to see the SPX coming back, which is another storied and legacy floor trading product. But Eurodollars is kind of in a class of its own when it comes to just the size and complexity of its floor trading operation. Folks at Cranes were digging into when CME plans to reopen that. We still don't have a date announced from CME. We have some folks coming out from CME next week, so maybe we'll pick their brains on that a little bit out there. But let's start there, John. I'm kind of curious. Obviously, you hang your hat in the rate side, talking to a lot of institutional players over there at RJO. What's it been like for you and for your clients over these past couple of months navigating this unprecedented market we find ourselves in, where the freaking Eurodollars, of all things, are completely electronic? What's it been like to get size trades done? Can you still get big prints done? And break it down for us in general. What's it been like last couple of months?
Well, it's been, you know what, Mark, surprisingly, it's been pretty smooth and easy. Look, I think there's a general acceptance by most players within our market that the speed of quote or the speed of price discovery may not be as quick on the screens as it is in the pit, but that's okay, because with volatility as high as it has been, February, March, and April specifically, you know, many of the players are willing to take that extra moment, make sure they're lining trades up correctly, and kind of get them done. So, you know, I think the CME has to be lauded a little bit because, look, first and foremost, I think the health of people, whether they be in office towers or down on the floor and in the pits, is certainly primary and first in mind, right? But look, the screens have actually done a very good job. They've done a very strong job. You have to be a bit more patient when executing. But that's in everybody's interest. That's in the market maker's interest, that's in the salesman's interest, and that is in the end user's interest. And so, you know, all things considered, given kind of what has taken place, and you know, in really a time and place where there's not much of a playbook, the transition to all electronic markets and execution within options has been relatively smooth, I think. And I think CME Group should be lauded for that. Would we like to see the floors come back? Without question. But we want to do it right. We want to do it safely. We want to do it correctly. It is another method by which price discovery happens. But price discovery over the last few months has worked well. It's worked very well. What I would likewise suggest to you is that the one thing that has also transpired here that we've noticed is that the liquidity providers and the market makers, when we're asked for quotes and we're trying to find perhaps liquidity in markets, is that if market makers won't leave quotes out there on screen. So for example, like, you know, you have to be sort of careful, especially as markets are moving and volatility is high. You don't want to leave a quote or a bid-ask spread out on the screens, because then if the market moves, then algos or other types of accounts can maybe pick off trades and quotes that are kind of resting out there or are stale in the market. So market makers have had to adjust, rightfully and accordingly so, to perhaps make markets on certain structures or whatever else, but then take those quotes off the screen so they just don't lay out there, get stale, and the market moves against them, and they kind of find themselves hung. That's really kind of sort of been the only sort of transition that I have noticed from this chair.
That's actually not too bad. You know, I think myself and maybe you and I know a lot of others were certainly concerned when this transition was first announced to fully electronic, particularly for products like the Eurodollars, which are so intricate and have such a large institutional flow to them and so many complex orders going up. It's the complex side, like in the SPX and, of course, in Eurodollars, where we see the most difficulty really transitioning to the upstairs environment. For logistic reasons, it's hard to quote these funky ratio spreads on a electronic basis, let alone getting the size liquidity you want source. So I'm actually pleasantly surprised to hear that it hasn't been that much of a transition for you over there, John, which I get is surprising and probably will surprise a lot of our listeners. Since we're talking Eurodollars, let's hang our hats there. Not the biggest mover and shaker of the week, but let's get into it nonetheless. I know all you rates heads out there, you want all rates all the time here on the show, so let's kick it off there. CMEGroup.com/TWIFO. It's where you go to generate your own report, choose the rates drop down, then select Eurodollars. Listeners, this is where I caution you. If you hit select all, like I like to do, it's going to be a lot of data coming at you. If you can handle a mountain of data, because Eurodollars goes for days, you'll be scrolling for a while, then have at it. If you do such a thing, you'll see that the lion's share of the volume, a decent week. I wouldn't say a blow your doors off options week this week. It looks like about closing in on about 1.3 million contracts out there so far, which isn't a ton in Eurodollars land. You know, sometimes we could see easily, close to 1 million on just a strike sometimes. So not exactly the most active of weeks out there, but it isn't really a rates-driven week. It's been a bunch of other things going on out there, including, like you mentioned, the equities firmly in the driver's seat. Coming into showtime, we saw the SEP contract leading the dance ever so slightly with just about 19% of the volume this week going up out there. The lion's share, the biggest print out here, looks like this is pretty light for Eurodollars. We've seen many, many hundreds of thousands. So maybe this is also perhaps reflective of what's going on with the lack of the trading floor. Maybe some of this paper is waiting to get those in-person open outcry prints again, because we're seeing the biggest print are the 99 7/8. How fun is it to say that again out there? Strike with about 43,000 and change out there. The biggest trade was actually today with about 19,000 and change, about 15,000, almost 16,000 on Tuesday. Remember, we were closed for the Memorial Day holiday here in the U.S. on Monday, listeners, so no volume there, also accounting for probably why it's a pretty light overall volume week, and about almost 12,000 contracts on Wednesday. The lion's share of that actually opening, about 10,000 contracts opening out there, so pretty interesting. Let's go out to the skew land and the vol. Coming into today's show, vol actually off a little bit. The Eurodollar is actually surprisingly unched on the week, so that's probably also attributing to the light volume, and of course the vol coming in a little bit. We've seen Eurodollars moving quite a bit of late, but this week kind of quiet. Of course, we do have the Fed coming up not too far, I think about 12 days or so out there, so maybe that's some folks playing wait and see out there as well. But the vol off about 2.5 points there, a little bit shy of a 22 in that the most active contract vol. So fairly volatile, but again, it's not a Bitcoin of 100 or anything along those lines, or even WTI out there as well, which we'll get to in a little bit. John, I'm curious for you. You've been putting up a lot of Eurodollars prints out here this week. Anything resonate with you in terms of large prints, or maybe any interesting directions or trades you're seeing going up here this week, sir?
Well, yeah, Mark, there have been a couple things. First and foremost is we have, a few weeks ago, the real big trade in Eurodollar option space was, of course, buying calls that were struck at par or 100, or even above par. Perhaps like the par and an eighth or the par and a quarters, for example, which really imply negative LIBOR rates. LIBOR being the underlying contract to which Eurodollars expire, and that has backed away a little bit. We're not seeing as much of that trade anymore. And in fact, I think as markets sort of settle in, sort of near this zero bound, banks, large money center banks, have certainly taken out insurance, and they took insurance out in the last few months about buying those calls that are priced above 100 or implying negative rates. As they have businesses and franchises that they need to protect from the negative rate environment. But that frenzy to buy those calls has really stopped and ceased. And now, as risk assets have sort of done their thing over the course of the last almost 2 months now, since those March 23rd lows, there's kind of a little bit of a backing away and perhaps an acceptance that, look, the front end of the curve is going to be pegged near zero, right? And we're probably going to see 2-year treasuries kind of trade roughly around 20 basis points to the overnight rate, and maybe see 5-year notes trade kind of closer, maybe 30 basis points over the overnight rate. But the overnight rate is going to be stuck at zero, and it's going to take something rather cataclysmic for the Fed to go below zero. My personal sense is they're not going to do it. I think the market, likewise too, is coming to a realization that the Fed really does not want to do it, and thus this buying frenzy of calls struck at the par level and above has really stopped, and that's a healthy sign for the market, in my opinion.
Yeah, that's a good point. I'm looking here right now, the paper that went up this week out here in Eurodollars. We did see some north of par prints, mostly earlier this week, and not for a ton of size, mostly a little bit farther out as well. We see June 2021. We see the 100 and a quarter. So breaking that par strike, going up 1,100 times on Tuesday and about 3,600 times on Wednesday. None today. So perhaps those fears abating today. So total of a little bit shy of 5,000 out there in June 2021. You get out to June of 2022, we see about 2,000 of those par and a quarter calls going up as well. So slight volume when you're talking Eurodollars numbers, but still some volume out there, perhaps showing negative rates. Speaking of negative rates, an interesting paper coming out from our friend Mr. Blue Putnam over there in CME land, all about this topic. It's a pretty meaty one, listeners. I encourage you to sink your teeth into. Set aside some time. It's about 20-odd pages full of great visuals and graphs as all the blue stuff tends to be out here. I'll just kind of break down some of the highlights for you. But he's kind of coming in and analyzing what it means. Of course, we did see, particularly at the height of the frenzy, like John alluded to, not as much now, but at the height of the frenzy a few months back, we saw this discussion, will the Fed go negative? Will the Fed go negative? We have seen this around the world in other times of crisis in the past, not really here in the U.S. And so Blue decided to analyze some of that and how it worked out. Obviously, the negative rates is desired to be a stimulus type event, trying to open up the economy a little bit in some cataclysmic type events. According to Blue's analysis here, he thinks that analyzing the other times it's been done by the ECB and others, they're not exactly stimulatory. At least they don't have the stimulatory effect that they hope they do. And in fact, they act as a bit of a tax on the banking system, which is kind of the opposite of the intended effect. Exchange rates, that's one of the primary drivers of the impact of what's going on out there. He says effectively a fall in the rates indicates negative rates are working. They're accommodative as anticipated. A rise in those rates indicates kind of the opposite, that indeed the impact was restrictive. He looks at 2019 in the Eurozone. He saw banks parking money, paying about almost over 7.5 billion euros to park money with the ECB. That's not exactly accommodative out there. So he thought it was the opposite. Banks are willing to pay that tax in order to have that security of their deposits. He's seen this in other areas as well. Again, this is a pretty lengthy paper in here. But in his view, he says a move into negative rate territory. It's just in general, it's a pessimistic viewpoint on the economy, and that also spooks people and makes them decide to maybe pay a tax to park their assets rather than put them to work doing what they want them to do, which is getting out there, lending, and opening up the economy again. So it's kind of a double whammy. The negative rates doesn't really have the intended psychological or indeed practical effect that people anticipated. He also mentions the trades that John was just talking about. We just broke down here. These trades above the par strike, indicating that there is indeed some concern about negative rates here. You can look at CME FedWatch as well. The next meeting's coming up in about 12 days in June. Not really pricing in a big negative move there. In fact, there's pretty much 99.9% that things are going to stay where they are, and not even 1% chance that they might raise them ever so slightly. Similar probabilities, a little bit less going out to July. You got to go all the way out to December, and even to next year, you still don't see really any size probability of all things negative going on out there. And again, I encourage you listeners to check out that report if you are curious about the impact of negative rates in some real-world examples. Blue does a great job breaking all that down. We'll get him back on the show again soon to parse that and all the other research in a lot more detail. We could talk rates for probably the rest of the show, but a lot of other things popping off. Let's get back out. We talked at the top of the show about how equities were really dominating the tape. If I'm going to talk equities, I'm pleased to be joined once again by my old friend, Mr. Sean Smith. Sean, welcome back. Sounds like the crisis is averted, sir.
Yeah, Sean Smith to the family rescue. It doesn't take a superpower like me to get a family emergency taken care of very quickly. So glad to be back. Sorry for the interruption. Did you go through upside and downside lists?
We did do that, yes. Russell 2000, I mean, you may have noticed, making yet another appearance there, number 2 to the upside, sir.
I knew it was going to be there because it just has outperformed, as we talk about so many times how small caps, when the market rebounds, and there's good economic or good news in regards to these small cap stocks here in the United States, that Russell outperforms to the upside when that type of news hits the headlines. It's that volatile index, and we're getting right into RECON space with our annual reconstitution of our indexes taking place in the month of June. So very excited to be back on the show to talk about stuff with you.
Yeah, it's coming up soon. It's the 5th is the initial additions and deletions coming up for the RECON. This is, as I've said before on the show, probably one of the more interesting, even if you don't watch small caps regularly, listeners, doing this now, this readjustment, this rebalancing, in light of the fact that, A, small caps have been moving more than just about any other index outside of the Nikkei this week, but go domestically, you're going to be hard-pressed to find anything that's moving more than them, A. And then B, just in light of all the impact of the coronavirus, what's that's going to mean for the names that are coming in and going out. So if you don't pay attention to RECON usually, I know a lot of you do, but even if you don't, you probably want to pay attention this time because it's going to be interesting on that front. Speaking of interesting, Mr. Sean, I know we talked earlier about, and we've had Tim McCord on the show. He's going to be back on again in a couple of weeks, I believe, to discuss this. We've joked about what a success these micro futures have been over there at CME, but they're kind of blowing the doors off it. And I've kind of held Tim's feet to the fire a few times now here on the show, saying, hey, when are we going to get the option? When are we going to get the options? The name is Options Insider Radio Network, after all, so we do have to ask that. It's kind of in our DNA. I know you can approximate it using some of the other products out there, but it's not quite an exact fit sometimes. So they do have some news for us, Sean. They did announce this week that options on these micro futures are coming, obviously pending regulatory approval, as they all say, but they're hoping for fall of 2020. Sean, does that get you excited? Because these futures have been lighting up. I'm going to go out on a limb and guess that perhaps the options will be pretty exciting as well, Sean.
You know, it's the natural evolution, right? It's first comes the underlying, and then comes the next level of derivative. And this is a perfect indication of tremendous volume and open interest growth, and a fantastic, successful suite of products CME Group has come out with. And it makes all the sense in the world that there's strong client demand for options on these products. So I'm very excited to see this evolution and this growth of product. And Tim McCourt, my hat's off to him. He's really knocking the cover off the ball with these products.
And John, I'm curious for you. Obviously, you hang your hat a lot in the institutional fixed income side, but I'm curious. Obviously, equities have been dominating of the tape for a lot of people, and certainly a lot of the mind share of late, whether it's small caps, large caps, what have you. What has been coming across your radar on the equity front these days? We talked about the valuation levels earlier. Have you seen a lot of interest in a lot of people putting on a lot of trades in the equity futures and or options? And also, as a corollary there, what are your thoughts on these micro futures? Have they been lighting it up over there in RJO as well, sir?
Well, the micro futures and options have been lighting it up here at RJ O'Brien, and there's a ton more growth potential within those products for the individual retail investor, and so I think CME should be applauded for kind of making their way towards that investor sector, because that's really going to be kind of where the room to grow is. The institutional side of the business is not exactly it's not in its infant stages. It's a rather mature. It's a rather mature industry, so certainly the micro products should do well. To your other question regarding equities and equity markets and the things that we're seeing and hearing, Mark, prior to the COVID-19 episode, there was a very popular strategy amongst larger wholesale institutional users of product where if you're certainly going to be long the underlying index or long the underlying product, you're always kind of looking for ways to generate alpha. And one of the ways to do it was to perhaps have some type of short volatility bias. And during the course of February, March, and April, a lot of those short volatility trades, which in many ways are carry trades, were either stopped out or blown up or had to be or had to be reduced. And what we are now seeing is much like spring, as flowers sort of start to kind of come out of the ground a little and bloom, we are starting to see more of a comfort level with selling volatility. Selling volatility was a trade for really kind of only the brave of heart or those with very large balance sheets, let's say 2 months ago. But as the VIX and other measures of risk market volatility have trended lower, you're once again sort of seeing this FOMO trade phenomena take place where there's more and more of a comfort knowing that both physical and monetary authorities have the back of the markets, where selling spikes in volatility is once again resurrecting itself to become a rather popular trade as well.
Yes, we have seen that. If you like talking equity volatility and harvesting, all that good stuff, listeners, of course, Volatility Views tomorrow, 1 p.m. Central, 2 p.m. Eastern is the place to go for that. But you're right, there has been a bit of a return of the old premium harvesting out there. Let's before we move on, talking about vol really quickly here, we'll do our little breakdown we like to do. Coming into showtime, we saw the VIX was right around a 28, about 27, 3/4, 28 or so. That puts it down a little over a point from where it was this time last week on the Epic TWIFO 200. The VVIX, which is the volatility of volatility, also has come off a wee bit. It was hovering around that 120 level, which is pretty frothy, now down about 15 handles or so, down to about 108 and a quarter or so. And our old friend, the RVX, a.k.a. the VIX of the Russell 2000, is still a heady 37.15. It puts it off about 4.5 handles from this time last show. That puts us off a little north of 9 handles on that spread now between VIX and RVX. So still wide, historically much wider than the average, but also off of the 11 points we saw last week. And I think close to 15 we saw a couple of weeks ago. Sean, any thoughts here on this still wide spread in the vol between small caps and large caps, but perhaps, as John alluded to, perhaps some of the premium harvesting strategies coming back to tighten that spread up again, sir?
We talk about this spread every show, and it's just a great discussion because it's just forever changing. And what a great opportunity to trade and spread small cap versus large cap volatility, the way this spread moves. We know small caps are more volatile, and the indication in the spread is clearly indicative of that, right? With RVX at the level that it's at, but you also see it coming in quite a bit, as you see when the market rallies as vols come in, but still at a healthy high level. But with the liquidity you get trading the RUT options at CBOE and getting that hedge off at CME, you've got you've got products with tremendous liquidity to get that trade and that hedge off in a fantastic fashion. So it all works. And, small caps are more volatile. And this is where we have that question that comes up from your listeners every once in a while. Yeah, these puts are pretty expensive compared to other index options. Why is that? And that's the skew in the downside puts. But the other question usually is, are they hedging or are they harvesting? And the answer is yes. You've got both sides of that trade. You've got people that are willing to buy those puts for protection, and you've got the harvesters that are looking to create that alpha that John mentioned. So it's one of those trades that these trades will just continue, and this volatility will continue to expand and contract. This volatility spread. We're still in volatile times, so really interesting topic, and always enjoy talking about it.
We are still in volatile times. That, of course, extends to other product categories as well, like, let's say, energy, which are leading the dark side here this week yet again. John, I'm not sure if you heard, but there was a little bit of tumult in the crude oil space over the past month or so. A little bit of a flirtation into negative territory. I'm not sure if that came across your radar. Maybe you were busy putting up some Eurodollar prints that day. But before we even get into what's going on in energy this week, I have to pick your brain a little bit. Obviously, those were unprecedented times in the crude oil space. We're actually seeing the listing. We were talking about listing strikes for negative rates there a little bit ago. We were actually listing options for negative strikes in crude oil, just unprecedented by just about any stretch of the imagination. Walk us through what that time was like over there at RJO. What did you see? What did you hear from your clients? And also, what were your thoughts on how all that played out?
Well, it's always fascinating because in my 27 years in the business, it was always sort of assumed that the zero bound meant zero. There was nothing less worthless than zero. With crude oil specifically, and the phenomena that is associated with trading crude oil, especially as it relates to delivery and storage, the whole concept of the contract and the curve trading below zero was something new. And it was really on the day that it took place, Mark. It was an example of crowd psychology. Because as you know, that day that the CME came out and made an announcement when crude was trading, when front month crude May was, I think, trading roughly around $11 a barrel, maybe 12, that in fact crude oil futures could trade negative. And and once the CME had made that announcement, that whole ancient dinosaur-like concept of the zero bound went away. And then it fed on itself, and it was reminiscent of what we had seen in rate space during the February-March period, when the ultra long bond was trading up 13, 15, and even 18 handles at a clip on very light liquidity and so it became sort of a psychological thing that sort of fed on itself, and then reversed almost as quickly as it went below zero. So really, it was you talk about times without a playbook or uniquely historical times like living through a pandemic, and certainly crude trading below zero was that, and it became, in my opinion, it became much more educational for those who were certainly kind of watch crude oil and are familiar with it, but didn't quite realize the embedded optionality of the crude oil futures contract, which happens to be storage costs and delivery, and those got repriced as well in a little bit of a volume vacuum, and it was fascinating to watch. It was a little crazy. It raised market nervousness. Obviously, that nervousness spread to volatility indices within both risk assets and riskless assets. And then it sort of quickly kind of recouped and recovered. But it was really fascinating in terms of watching something actually break the zero bound and do it pretty substantially.
Yeah, a little crazy. I think that's the euphemistic way to put it. It certainly was that. And you're right. People had to have an entire re-education of how they viewed these products. I know more than a few brokers had to have that at a very last minute there as well. We heard from a lot of people on the network who wrote in saying, I saw the future trading for a few cents. Why not take a flyer on it? Not thinking that they could lose 40 handles in the other direction. So, yeah, it was an eye-opener, I think, for a lot of people out there. And certainly going forward, something that will perhaps be taken with a little bit more consideration. Hopefully we won't see that appearing again. Maybe the return of the pits will perhaps bring some semblance of sanity to that again. Some people have speculated that WTI never would have broken that zero bound, as you put it, with pit trading there. Obviously, we will never know for sure, but it's an interesting thing to speculate on, and certainly one that will be postulated out there as the floors start to come back, particularly in CME land this week. Looking out here at WTI this week, I said it was off from our last show last week as our movies and shakers. This week here, aka the name, this week in futures options, we're seeing WTI up a little bit, about 33.80 or so, puts it up not quite 2%, about 1.75% or so on the week. So getting a little bit of a lift. We saw these things kind of stabilizing after some rumors earlier this week that the Saudis and OPEC were going to extend their production cuts throughout the end of 2020. So this ridiculous price war, hopefully a thing of the past. Unfortunately, though, for the bulls out there, we did see API reporting a unexpectedly large crude build yesterday. Folks waiting for the EIA numbers to maybe confirm that. Of course, crude build, inventory builds, that's what sent us into that negative spiral last month. So some folks seeing that and getting a little bit skittish, probably understandably so. So some interesting stuff out there. Looking at the vol, a little bit firmer this week, up about a point and change in these nearer duration contracts, and about half a point a little bit farther out. Not surprising, a little bit of uncertainty going on out there, but not still explosively volatile. A little bit more volatile right now out here in this most active contract, which is the July contract. A little bit shy of a 24, about 23 3/4 vol. So about similar volatility actually right now than what we're seeing out there in the Eurodollars. A little bit more out there. So it's come off quite a bit from the extraordinary levels of vol we saw not too long ago out here. Again, the July contract was where the action was, and it was the 30 puts that were leading the dance this week. A whopping 70 handles away from that negative 40 strike we hit not too long ago. 30 puts with about not quite 10,000 contracts, about 9,700 contracts. The lion's share coming in, let's see, the largest print out here was today, actually, about 4,500, about 3,000 yesterday, about 2,300 on Tuesday. So even money strikes kind of where the action was this week. Not exactly surprising. Let's go out a little bit farther out here. Also saw 36 calls, pretty active out here in September, about 5,300 of those. Let's look at the skew out here in this July contract. That's where, again, about 37% of the paper went up this week. The puts were about 9% rich to the at-the-money last week. This week, they've gotten a little bit juicier. They're about 14.1% rich to the at-the-money. By the way, this contract has about 20 days left, so it falls well outside of our 2-week threshold for analyzing skew. The calls were cheap last week. They were 5.5% cheap this week, even cheaper. They're 11.6% cheap this week. So calls coming in, puts getting bid, kind of the tail of the tape usually out there in WTI playing out yet again this week. So fascinating stuff. I know some folks were concerned about perhaps seeing a repeat of last month with the front contract. So far, it seems like these storage concerns were building, perhaps not quite at the levels we saw last time, which I think will probably be a breath of fresh air for a lot of people out there. Speaking of breaths of fresh air, let's see if you guys can provide some of those as well with a little bit of your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/The Options Insider, stocktwits.com/Options Insider, or via questions at theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, let's get into it. First off, a lot of you guys are popping off about the comments we made on the last show about silver potentially going over 20. They were looking at it through the lens of SLV on the option block. A lot of you guys chiming in on that comment. Got Goldies. I wonder what his viewpoint is. Scott Goldies said he believes it'll actually hit. I think the comment was the SLV will hit 20 before all this is said and done. He says he thinks it'll hit 21 before the end of June. I'm guessing Got Goldies has some 21 and above options on in the June contract expiration there. So we'll keep an eye on that, Got Goldies. We'll see how that works out. A longtime listener, Mr. Mark Brandt, chiming in saying, if that happens, if silver gets above 20, he says his calendar straddles will love it. So I guess he's got some calendar straddles going on up there in silver, which is kind of interesting. Silver, we've often joked, kind of the stepchild to gold. Gold gets all the love out there, but silver has been moving a little bit of late, and perhaps one worthy of watching. Sounds like a lot of you guys out there are trading it, so good luck to all of you out there. We'll keep an eye on SLV and indeed silver in general. Ryan Bell chiming in with a timely request. He says, great program. Well, thank you, Ryan. He goes on to say, can you bring on some futures options brokers onto the show so we can hear what's going on from their perspective? Well, Ryan, I hope you were listening to the show today because you got your wish. We broke the drought here with RJO. I can't believe we never had him on the network before. It's an oversight on our part there. But there you go, John C. Our listeners ask and they shall receive. You get to fill the hot seat. I think doing an able job today, if I do say so myself, John.
Well, thank you very much. It's an honor to be here, so thank you.
There you go, listeners. You ask and you shall receive. Not always going to be this quick, but it just worked out that way today. Hopefully you, Ryan, and everyone else out there who likes to see what's going on the FCM side and indeed what the brokers are seeing on their platforms. Trying to get a little bit of that color for you on here as well. I like this one just because he calls you FTSE guy, Sean. Dave Zabrinsky chiming in here. He says, Mark, FTSE guy and guest. I guess that's you, Sean. You're the FTSE guy. I like that. He says, I know your viewpoints on straddles as a trading vehicle, but what about as a sentiment indicator? Do they provide meaningful insights in that perspective, or are there better tools in your opinion? Well, yeah, we talked a lot about long straddles in general, a difficult trade, particularly for retail to make profitable. There was a period where they were profitable, and guess when that was? We talked about it on the network. It was a few months ago, back at the height of the madness when we were hitting limit down every day, and vol was exploding. It was expensive, but still those straddles were paying off. So that's the kind of environment you need to make a long straddle really pay off, listeners. Otherwise, it's a very delicate dance, death by 1,000 cuts. You've heard me say it before many times. But as to Dave's question, the sentiment value of strategy, I think those are very valuable. In fact, if you listen to our option block show, we do a whole breakdown. We make it available for you guys over there for free, theoptionsinsider.com, of the earnings straddles going on for earnings season during every different big name reporting throughout the entirety of the season, what they've delivered in the past, what they've priced in the past, what they're pricing in right now, how they compare and contrast. All sorts of great data, completely free. So get it over there, theoptionsinsider.com, if that sort of stuff is of interest to you. And you can apply that same analysis to anything. You can apply it to corn, you can apply it to Eurodollars, you can apply it to WTI. It's not just in the equity landscape. So yes, short answer to your question here, Dave. Yes, I'm a big fan of straddles. I think they are much more valuable as you put it, sentiment indicator than, let's say, an analyst whisper number or something else like that, or what people are expecting for a crop report or something along those lines out there. Since he called you FTSE guy, Sean, I'll let you chime in on this one as well. What do you have to say about A, your new title of FTSE guy, which I like, and then B, what are your thoughts on straddles, sir?
They're an indicator. They're big. They're the equation in volatility, the at-the-money straddle. I can't remember how many times, either as a trader myself, trading equity derivatives, or from the days where I was a broker working for a couple of FCMs in my past. But where's the at-the-money? Where's the front-month at-the-money straddle? Was always an indicator of where volatility was, and it's still a strong measure and always will be. It's part of that volatility equation that derivatives traders look at because a straddle, if volatility stays the same, only decays by its interest rate to the next day, right? So if there's been just a couple of cents of decay, that volatility is staying strong. So it's that volatility indicator that traders to this day will use and will always use.
John, I'm curious on your thoughts here, as Dave puts it, on straddles as a sentiment indicator. When I was out in the index pits back in the day, our day was filled with institutional clients calling us up and asking for straddle runs. They wanted to see what was going on from a vol perspective along the term structure. A, is that still the case? Are you still giving your clients the straddle runs? Is that still the case out there on the institutional client front? And then B, what are your thoughts, as Dave puts it, of straddles as an indicator, sir?
So I have a mixed answer for you, Mark, and I beg you to work with me. Straddles are important without question, but given volatility and what volatility has done in the last few months, as well as episodic bouts of volatility in the last few years, for us and for our institutional users, we tend to kind of pay a little bit more attention to skew and tend to look at more the 15 to 20 delta calls and puts in terms of implied vol and look for relative value opportunities along those skews. So whether we're trying to generate alpha or we're trying to hedge out asset liability management risk or perhaps take curve risk or whatever else, we find almost more value in the 15 to 20 delta calls in terms of what their implied vols levels are. Again, trying to avoid that whole trade of death by 1,000 cuts. But we'll look at straddles. We'll look at straddles when the skews kind of get a little bit rich or kind of a little steep, as we would call them. So, for example, like right now in August 10-year straddles, which expire in late July, we would argue to our clients that both the call and the put skews, those vol smiles, are rather steep. And so from a relative value perspective, if you have an option position that you need to hedge out, that perhaps using straddles on a relative value basis makes a little bit more sense. We look to maybe kind of take advantage of those 15 and 20 delta calls or puts when volatility smiles are flat, right, or maybe even frowns. So are straddles used by the larger institutional accounts? Without question. But they're used more in a relative value sense in terms of how they trade on an applied vol level versus the wings, the 15 and 20 deltas type stuff. And so that's how we use them.
Well said, sir. The game continues to evolve, and you're right, the at-the-money straddle can only tell you so much. Hence why we break down skew here every week on the show in the major products. That's showing you what's going on in the wings, which is equally, if not more, important out there. We don't just give you a straddle run here on the show every week, even though that'd be nice and easy. But a lot more to do. So there you go, Dave. Some interesting use cases of what's going on out there from a straddle and indeed now a strangle/risk reversal perspective as well. Unfortunately, that music, listeners, means we've come to the end. Man, it's amazing how quickly an hour flies by when we're talking all things futures options. John, you did an able job holding down that CME Group hot seat today. I know it can get a little uncomfortable, a little squirmy, but you survived for a full hour. So congrats to you, sir. And then if our listeners are intrigued, maybe they want to reach out to you over there at RJO. Maybe you want to leave us with a little bit of a hint, a little bit of a tease of what you got coming down the pike over there at RJO. Now is the time, sir. The floor is yours.
Well, in terms of kind of what we have going here, again, I think the main trade is we're still sort of slaves to the news wires and news developments. In fact, Mark, sort of as we've been on, President Trump has announced a 2 p.m. White House press conference tomorrow where he'll address U.S.-Chinese relations, and he's also suggested that between now and the close of equities in about 30 minutes, he's going to sign his executive order on social media platforms. And so, look, I mean, we're still somewhat slaves to sort of what's going on within the geopolitical sphere. And so, look, that's going to create opportunities, we think. Longer term macro type theme, we would suggest that there's been a dichotomy between treasuries and riskless assets as well as risk assets. Risk assets seem to be pricing in perhaps a little bit the increased odds of maybe a stronger reopening of the economy later on this year, whereas the treasury market is not. And so, in terms of flatness of curve or potential for repricings, we think here at RJ O'Brien that a cognizant argument can be made that perhaps the long end of the treasury curve is a little bit more vulnerable to a rise in yields if in fact the economy is able to kind of reopen a little more successfully than what's priced in currently, come let's say the third and fourth quarter. And so equity markets seem to be kind of telling us one thing. The long end of the treasury curve seem to be telling us another thing. And put skew, we think, kind of maybe offers a little bit of opportunity, let's say from the 7-year point, i.e. TY, out to the ultra long bond point. So we would encourage kind of investors to sort of take a look at those that theme, that story, in terms of what's getting priced in, and certainly kind of reach out to RJ O'Brien if that's an idea you'd like to further explore.
Well said, sir. You guys know where to find them if you want to learn more. RJO'Brien.com. RJO Brien, B-R-I-E-N, not an A, E-N. Over there.com is the place to go. Whether you're on the institutional side, a lot of you on the retail side listening to this program, or in between, head on over there. Kick the tires and light the fires. Glad we could break the RJO drought. Have to bring you back on again soon, sir. And Mr. Sean, your big day is approaching. It is fast going to be upon us, sir. Give us a little bit of insight into what's lighting up your tape as RECON approaches, sir.
Thanks, Mark. And again, thanks for having me on the show. And my compliments to John and to RJ O'Brien, one of the premier FCMs that is truly a global firm and has tremendous products and services. I've been a fan of Jerry Corcoran and the company for many, many years, and my compliments to RJ O'Brien. But back to FTSE Russell and the Russell reconstitution that's just gearing up. As we said, the preliminary lists are being communicated on June 5th of the indices, but there'll be updates every Friday up until RECON Day on June 26th. So look for edits to those lists on the 12th and then again on the 19th, culminating on the 26th at the close, where we always see massive record volume on the closing bell at our partner exchanges, NASDAQ and New York Stock Exchange. So looking forward to a fantastic RECON. But before I go, I also want to recommend you go to our website, and I've actually sent the link in to you, and I think Gene, your right hand is going to tweet that out today. But there's some fantastic webinars to talk about volatility in small caps during this pandemic and how markets react. There's a fantastic webinar with our partner exchange and a fantastic market analyst from Jefferies that does just a fantastic job talking about small caps and how they've been moving and what to expect in terms of market performance in the coming weeks and months. So please go to FTSERussell.com/webinars, and you can hear a recording of that fantastic webinar, of which I'm the MC. So you'll get that FTSE guy again, and look forward to it. But stay tuned for more updates on reconstitution as we get closer to that big day on the 26th. And thanks again for having me today, Mark.
Happy to do it, sir. FTSE Russell is the place to go. Of course, FTSERussell.com/webinars if you want to get the webinar with that FTSE guy and a few other nuggets. Sounds like a lot of you enjoyed that webinar. If you want to get the recording of it, FTSERussell.com/webinars is the place to go. Give a follow on the old Twitters while you're at it as well, at FTSE Russell. And on behalf of Mr. Sean and John, who did an able job holding down the CME Group hot seat today, and of course our friends at CME and myself, I want to thank all of you out there for downloading, streaming, subscribing, for listening live, for sending in so many great questions and comments. Keep them coming. We love hearing from you guys. We heard from a bunch of you last week on TWIFO 200. We'll do that again soon. Don't you worry. And we'll see you back here tomorrow, 1 p.m. Central for Volatility Views. And we're back again on Monday for Option Block all the way through to Thursday for more of This Week in Futures Options.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit FTSERussell.com, CBOE.com, and CMEGroup.com. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.